Okay, let's now start by explaining in more details on many different scenarios the situation of the buyer and the writer of the call option and the payoff and the gain and loss for each one of them. Let's assume that we are going to sign a contract on a company stock called ABC, for example. And the contract includes some information. The strike price is $55 and the volume and the quantity is 1,000 shares, and the total investment of this option is $1,000. So if you know that the total investment of this option is $1,000 and the option is about 1,000 shares, so the cost to acquire one share is simply dividing the $1,000, which is the investment, by the 1,000 shares that we have. So this will be the cost to acquire the option contract for one share only. Okay, and the duration of this contract is 30 days, and the purchase price, the purchase date of this contract is 10th of June. Now, assume that on this date, which is in 10th of June, the market price was $50 for the same company stock. Now, the first thing that we need to do is to calculate the break-even price for this option. The break-even price for the call option is simply sum of the strike price plus the $1, which is the cost to acquire the option per one share that we have calculated before. So now the cost will be the break-even price, will be $56 for this share. What are the scenarios that we have? We are going to explain. Scenario number one: after 1 month, the market price of the stock will be 40. This is the first scenario. Scenario number two: in the same date, it might be 50, might be 55, 60, 70. So simply I put all of these scenarios in this chart. So to say this is the purchase price that we have on 10th of June. So we purchased, for example, assume that the market price is 50. So these are the different scenarios that we have for this stock during 1 month. Okay, now let's say that we have two options or two ways to acquire this stock. One of this way is to go to the market directly and acquire the stock on 10th of June, and in this case we are going to pay $50. And the other way is to purchase option contract and then start assessing whether to utilize this contract or not, as we did in the previous example. Now let's say that we are going to follow the first way to acquire this purchase and purchase the stock on the date of 10th of June at $50 per share. In this case, and in the first scenario, after 1 month, the market price dropped down to 40. So now you purchased at 50 and the market price now today is 40, so you have loss. So how much is your loss? My loss will be the difference between 40 minus 50. This will be multiplied by the number of stock that you purchased. So the total loss that you have in this case is $10,000. So this is the total loss if you purchased from the market and you didn't purchase the option contract from the beginning. And for the second scenario, assume that the market price is 50 and you originally purchased at 50. So in this case, you don't have any gain or you don't have any loss. The purchase price equal to the market price as of today, so you don't have any difference here. So this will be 50 minus 50 times the 1,000 shares that you purchased. So it will be break even. You don't have any gain and you don't have any loss. Please consider that I ignore the commission and the transaction fees, because if there is a transaction fees, and there will be, it will be considered as a loss as in this case or in the second scenario. So I'm ignoring the transaction cost or the commission of the broker itself. In the third scenario, the market price will be more than the purchase price that you paid in the beginning. You paid in the beginning $50. And now the market price is 55. So you started to achieve some gains. So the gain here will be the difference between the market price and the purchase price that you are going to do. That you bid already in the beginning. So this will be multiplied by the number of shares that you purchased. So the scenario here will result in gain of $5,000. If you take this scenario for the other if you take this formula to the other scenario, you will find that you started to achieve gain as long as the market price increased over the purchase price. So this is the purchase price at 50. As long as the market price increase, so you start to achieve the gain, which is the difference between the market price and the purchase price. So let's now calculate the gain and loss percentage. If your loss in the first scenario is 10,000, how much is this loss as a percentage from your investment? So simply you are going to divide this $1,000 by the investment that you paid in order to purchase this stock. So you purchased 1,000 share and you paid initially $50,000. So this will be the total investment that you paid in the beginning in order to acquire this stock. So now you are going to take this formula and go to the right, and you will find that this is the percentage of your income and gain and loss relative to your investment. So this is the first scenario. Let's go to the second option, and here in the second option you are going to purchase option contract, and the option contract you agreed on the other party, which is the writer or the seller of this contract, that you have a strike price of $55 and you paid $1,000 as initial investment. So now let's start by considering or calculating the payoff for the buyer of the option contract. Assume that in the first scenario the market price after 1 month reached to 40. So now you are in a decision to take whether to purchase from the market at 40 or to exercise the option contract and pay 55. So what is best beneficial? What is more beneficial for you? Paying 40 or paying 55? Definitely you are going to pay $40. And in this case, you only lost the investment that you paid in the beginning, the initial investment, which is $1,000. So in this case, I am going to say that my loss will be only $1,000 that I paid in the beginning. And why? Because actually I purchased the option, I didn't use it, so I lost $1,000. And by the way, this is the maximum loss that the buyer of the call option can have at any scenario. So this will be $1,000. Let's take another scenario. If after 1 month the market price was $50 and the strike price is 55, are you going to pay $50 or 55? Definitely, if I would like to purchase this stock, I'm going to pay $50. Again, in this case, you have the loss equal to the initial investment that you paid in the beginning. So you are going to say my loss is also equal to $1,000. Okay, in scenario number 3, the market price is 55 and the strike price in the option contract is 55. Now, purchasing from the market or exercising the option both will result in outflow of cash 55 in any scenario of these two scenarios. And in this case, you paid initial investment, which is $1,000. If you didn't purchase the contract and you didn't pay this $1,000 and you want to purchase from the market at 55, so you can save this $1,000 that you paid. So this $1,000 in this case will be considered also as a loss. So in this case, you are going to say that I still have $1,000 I paid initially in the beginning, and now the market price equal to the exercise price. So it was much better to not enter in this contract because you lost $1,000 in the beginning. So this will be my same losses that I have. What if in scenario 4 that the market price increased to 60? So now you have two options, whether to go to the market and purchase at 60 or to exercise the contract and pay 55. Definitely the answer is to exercise the contract and pay 55. And in this case, you are going to start achieve some gains, because if you exercise the option and you purchased at 55, you can sell the same stock on the same day at 60. So you can achieve $5 gain on the same time on spot. Now you started to achieve gain, which is $5. But remember that you paid investment at the beginning $1,000, and the cost of one share for this investment is $1. So the net gain that you have now is $4,000 as a net gain. Okay, now go to the last scenario. It will be the same, 70 against 55. So definitely you are going to select purchasing and utilizing and exercising the option contract and pay 55. Now you have a difference. If you paid $55 now and you purchase the stock from the option, you can sell it in the market and achieve the difference between 70 and 55, which is $15 per share. Remember, you have a cost $1, so the net gain for you will be $14 per share. And how many shares you have? 1,000. So you are going to say my gain will be $14,000. Now, if you would like to calculate the percentage of your gain and loss, you have to divide this gain and loss by your investment that I paid in the beginning. You paid in the beginning $1,000, and this is your gain and loss. So you are going to divide the same by $1,000, which is your investment. Look on the gain and loss percentage. You will find yourself that the maximum loss that you have is to lose the initial investment that you paid. But the gain and the income is open for you. The sky is open for your gains. You will find that your gain is increasing as long as the market price in the market is increasing. So your gain and the gain percentage is increasing. You might achieve 1,400%, 1,400% as gain percentage of your investment if the price in the market is 70. Compare it with the scenario number 5 in the first option is to purchase from the market directly. In the same scenario, you are achieving 40% gain. But in the option contract, you are achieving 1,400% gain. And that's why the option contract will help you to limit the investment that you are paying. In the first option here, you paid the purchase price of the stock in the market, which is $50,000. In the first option here, in order to acquire the stock from the market, you paid $50,000. But if you sign the option contract, you only paid $1,000. That's why option is limiting your investment. If you don't have availability of funds to invest in the market, you can start trading in the option, because the investment that you are paying under the option contract is limited. It's not too much. And number 2 is limiting the loss, because actually the loss is limited only, the maximum loss is limited only to the investment that I paid to purchase this option contract. But in the case of purchasing from the market, your loss is open. You might lose, for example, $10,000 if the price is 40. But in the same scenario here, you only lost 1,000. So loss is limited, risk is mitigated. Investment also, if you don't have too much investment to start trading in the market, you can start trading the market with a minimal investment if you purchase the option contract. So in this case, in the buyer, we need to determine whether the buyer is in the money or out of the money. So if the buyer is achieving loss, so he is going to be out of the money. He didn't utilize the option, so he's out of the money. So as long as it is lost, so it will be out of money. Okay, and so this will be the same, and starting from achieving gain, so the buyer will be in the position of in money. The option contract for the buyer will be in money. So we are going to say that, so this will be in money. This is from the buyer side. How about the other party who sold this option to the buyer? The other party is called seller or writer, and we need to calculate also the gain and loss for him. As I explained before in the first scenario or in the first example, the gain in one party will be considered as a loss in the other party. So whatever loss is here will be considered gain for the other party, and whatever gain here will be considered losses on the other party. So now let's see. If the buyer here achieved losses, so this will be considered as a gain for the writer or the seller of the contract. So this will be the result. Look in the situation here. The seller and the writer can achieve gain with a cap. The maximum gain that the writer can achieve is only $1,000. Let's understand. If you are a buyer and you didn't exercise the option, so you will not go to the seller asking him to exercise. So you are not going to exercise. Exactly like this case, you didn't exercise the option. So the seller here got a benefit and got a gain, which is the initial investment you bet to him. So this is the maximum gain the seller and the writer can achieve. So this is the maximum gain. But look on the loss for the seller and the writer. The loss is open. So the writer is charging with very high risk. If the market price increased over the strike price in the case of the call option. The loss is open. And so in this scenario, he lost 4,000. In this scenario, he lost 14,000 because actually the gain will be considered as a loss on the other party. And if you like to calculate the percentage of the gain and loss, exactly you need to divide this by the investment, by the amount he collected in the beginning, which is $1,000. So in this case, you will find the loss is very high if the market price increased over the strike price. In this tutorial, we explained what is the meaning of option contract, what are the parties in the option contract, what are the components in the option contract, how can we calculate the payoff and gain and loss for each party, whether it's buyer and seller, how can we determine the option contract is in the money or out of the money, and how investors can utilize the option contract in case that they have limited investment and if they would like to limit the losses and mitigate their risk. I hope this tutorial is helpful for you. This tutorial is helpful for investors who are going to trade in the derivatives market in Saudi Arabia. Is helpful also for CMA students part 2, and this is helpful also for CTB students who are studying Certified Treasury Professional certification. I hope this tutorial is helpful for you for understanding the option and the call option contract. Thank you.